Welcome to Accounting Standard Revision with AI series. This series is designed by more classes. Today we are going to discuss about framework for preparation and presentation of financial statements. So what is this framework really? Well, you can think of it as the constitution for all financial reporting in India. It was issued way back in July 2000 by the Accounting Standards Board of the ICAI, and it's the very foundation that all our accounting standards are built on. It lays out the core concepts everyone has to follow. So let's dive right in. To keep this revision session super clear, we're going to break it down into 5 key areas. First, we'll look at the framework's overall blueprint. Then, we'll get into the fundamental assumptions that everything else rests on. After that, we'll explore what makes financial info actually useful, define the 5 core elements of accounting, and wrap up by looking at how we put a price tag on everything. All right, first up, the blueprint. Now, this isn't just some dusty old document. Think of it as the master plan. It provides the core concepts that guide how every single accounting standard is created and applied. This ensures that everyone, from a tiny startup to a massive multinational, is speaking the same financial language. So, who actually uses this thing? Well, pretty much everyone involved in finance. Enterprises need it to get their statements right. The Accounting Standards Board uses it as their guide for developing new standards. Auditors rely on it to form their opinions. And maybe most importantly, you, the users of these statements, like investors, need it to make sense of all the information presented. According to the framework, a complete set of financial statements has 4 key parts. You've got the balance sheet, which is like a financial snapshot in time, what you own and what you owe. Then there's the statement of profit and loss, which tells the story of your performance over a period. The cash flow statement, well, it does exactly what it says. It follows the money. And finally, you have the notes, which is where all the juicy details and extra explanations live. Okay, so we know the parts of the statements, but what about the invisible rules that hold them all together? Underpinning everything are 3 fundamental assumptions. These are the pillars that are so foundational we just assume they're being followed, unless a company specifically says they're not. And what are these 3 pillars? They are going concern, the accrual basis, and consistency. Just think of these as the absolute non-negotiables of the accounting world. If a company ever breaks one of these rules, they have to come out and tell you. Now, check this out, because it really shows you just how critical that going concern assumption is. This is the idea that the business will keep running for the foreseeable future. If that's true, you depreciate your assets over their useful life. But if it's not true, and the business might be shutting down, everything changes. Those same assets are valued at what you could sell them for today, their net realizable value, and any deferred costs get written off immediately. It's a night and day difference. The second pillar is the accrual basis, and it's a big one. It simply means we recognize transactions when they happen, not when the cash actually moves. So you record revenue the moment you earn it, not just when the customer's payment hits your bank account. And in India, this isn't just a good idea. It's the law for companies under the Companies Act. Okay, we've got our assumptions locked in. But what actually makes financial information good? Useful for making real decisions. That's where these qualitative characteristics come into play. They're the hallmarks of high-quality financial reporting. The framework points to 4 main qualities. First, the info has to be understandable, even for someone who isn't a CPA. It has to be relevant to the decisions you're trying to make. It absolutely has to be reliable, meaning you can trust it. And finally, it has to be comparable, so you can measure it against last year's numbers or against a competitor. Let's drill down a bit on reliability. For information to be reliable, it has to be free from any major errors or bias. And you get there by making sure it faithfully represents what really happened, that it reflects the economic substance over just the legal form, that it's neutral, and that it's complete. It's all about telling the whole unbiased truth. And then there's comparability. This is what makes real analysis possible. It lets you compare a company's performance against itself over time, that's intrafirm, and against its competitors, which is interfirm. This is exactly why if a company changes an accounting policy, they have to tell you the financial impact. It's also you can still make a fair apples-to-apples comparison. All right, let's move on to the actual language of business, the 5 core elements. Every single transaction, no matter how simple or complex, gets sorted into one of these 5 buckets to build the financial statements. So what are they? Assets, liabilities, equity, income, and expenses. That's it. Every single number you see on a balance sheet or an income statement belongs to one of these 5 families. Let's quickly define each one. An asset is a resource the company controls because of something that happened in the past and expects to get some future economic benefit from it. The key ideas here are control and future economic benefits. A liability is a present obligation, also from a past event. But here, settling that obligation is going to mean an outflow of resources from the company. So the key concepts are present obligation and outflow. Equity is pretty simple. It's what's left over. It's the residual interest in the company's assets after you've paid off all of its liabilities. And there it is, the most famous equation in accounting, right on your screen. Assets minus liabilities equals equity. It's the owner's claim on the business. Income is anything that makes the company's pot of wealth bigger. It can be an inflow of assets, like cash from a sale, or a decrease in a liability. Either way, the end result is an increase in the owner's equity. And this covers both your regular day-to-day revenue and any one-off gains. And you guessed it, expenses are the exact opposite. They are a decrease in economic benefits. This happens when assets flow out or get used up, like when you pay salaries, or when you take on a new liability. The end result is always a drop in equity. So we've defined the elements, but how much are they worth? How do we assign a monetary value to them? And how do we even know if a business is actually profitable or just burning through its capital? That brings us to our last section, measurement and capital maintenance. The framework gives us 4 different ways to measure things. Historical cost, what you originally paid for something, is by far the most common. But you also have current cost, which is what it would cost to replace it today, realizable value, which is what you could sell it for, and present value, which is based on future cash flows. Each method gives you a totally different view of value. Now, this leads to a really profound question. What even is profit? Under financial capital maintenance, you've made a profit if you just have more money at the end of the year than you started with. Simple. But under physical capital maintenance, you've only made a profit if your actual productive capacity has gone up. For instance, can you now make 110 cars instead of 100? It's a huge difference between being richer in cash versus being better at doing business. And that leaves us with one final thought to tie this all together. Think about this. How does the simple choice between using the original historical cost versus today's current cost completely change not just the profit number you report, but a company's real-world ability to replace its assets and stay in business? This concludes the second episode on the framework for the preparation and presentation of financial statements from the podcast series Accounting Standard Revision with AI by Mori Classes. I trust this detailed discussion has provided clarity on the framework, advantages, and implementation strategy of accounting standards in India, including the progression towards international convergence. I wish you the very best for your forthcoming studies and examinations. If this video was helpful, please share it with others. We greatly appreciate your support, including subscribing to our channel and leaving comments with your feedback and suggestions for future topics.